It's a very good question, and I don't get asked that question enough. I wish I'd get it more. So here's a perfect sentence to frame that argument. US Treasury bonds at 0.7% interest today are the same risk-adjusted returns as marijuana at 50% a year. Okay? So when you look at it, you're on the one side, you invest in the marijuana industry in the US, which is still illegal at a federal level, but it's legal at a state level, and you're making 50% a year. Okay. Mm-hmm. And then on the other side, you invest in US Treasury bonds at 0.7% for a 10-year investment. The way that the world works, these are both the same. And you might say, how can 50% be the same as 0.7? The answer is you're adjusting for risk. The risk inherent to treasury bonds is nothing. The entire world economic system must first collapse fully for there to be any risk in US treasury bonds. Whereas on marijuana, right now, you could be getting 10, 20% annualized. So you know that when the property sells, you're going to make 50%. But tomorrow, one state or the feds could change the rules, which completely tanks that industry. It already doesn't have banking. Marijuana doesn't allow banking. You can't go into a bank and put marijuana money in there. Mm-hmm. And all of a sudden, it's gone. And then everything else from in between marijuana, which I consider to be the highest, kind of the most risky investment that you can really make at scale, and treasury bonds, which is, one of the largest investments in the world, but it's at the lower end. Everything in between sits on a sliding scale. As returns go up, risk goes up. And so when you're saying, I make 30% and Billy makes 20%, where I'm making more than Billy, no, you're not. You're very likely to be on the same scale. Billy's just taking a lot less risk than you are. So someone who is buying a Class A property that is in downtown and is willing to take almost zero cash flow, 2% or 3%, he's just making sure that his downside is lower. That is an investor with a much lower risk level return. Now, there is a way to hack the system, and that's data, right? So let me give you an example. So there are 3,000 tertiary markets in the United States. And on a post-COVID basis, 1 out of 3,000, has positive employment growth. Can you imagine positive employment growth during COVID? I mean, that's just not possible. But so we had access to those 3,000 markets worth of data. We've spent a huge amount of money and time. And so when we sorted the data just for shits and giggles, we were like, let's take a look at it, see which one has lost the least. We found a city in the US that was gaining in employment during COVID. And we were like, how could this even be possible? This is a data error. There has to be some kind of error. So we go and we call people in the city. It's called Idaho Falls. It's the second largest city in Idaho. Idaho happens to be the fastest growing state in the union. So there was something there that made us think, maybe this could be right. Well, as it happens, there is an energy laboratory near Idaho Falls. So it's about 10 or 15 miles away. This laboratory has $5 billion worth of grants that have already been made. So this is money that's allocated. And over the last 4 or 5 years, the laboratory has been getting ready to spend this money. And over the last 6 months, they finally got to the point where the grants can trigger. Now they've got 15,000 people to hire in a city of less than 100,000 people. So at this point, Idaho Falls represents a city where you can screw up every damn thing and still make a humongous amount of money in real estate. That's how you can actually mess with the risk reward. Gotcha. Because the reward in Idaho Falls is massively beyond the risk level because it's pre-allocated money, right? So it's already allocated. Even if the Democrats come to power, they can't unallocate this money because it was allocated through a bond. And so no matter what happens, the employment levels in Idaho Falls for the next 5 or 6 years will not just be higher than the US, they will crush the US by 2x or 3x multiple. And nothing works like jobs when it comes to real estate. So we look for places like that, places you've never heard of. Dalton, Georgia, a city of 33,000 people, carpet capital of the world. Well, it has, because of its mountains, there's no land left. You can't build anything. right? So as a result, each year as the city grows, there's more and more compression, which leads to rate and the price increases. St. George, Utah, which is the only warm city in Utah. Utah's a cold state. They've done phenomenally well. They're the second fastest growing state in the US after Idaho. And so they have all this money that people in Salt Lake and Provo have, but it's really cold. But if you just jump into a commuter flight that's 25 minutes and go directly south, you're going to end up in St. George surrounded by red colored mountains and phenomenal temperatures, right? And Zion National Park, that's 20 minutes away. 3 million people go there. So can you imagine today, all those rich Utahns, if they want to escape COVID, guess where they're going? St. George. So St. George as a city has a occupancy for their multifamily of 99.2, which is by far the highest in the US, right? Nothing comes close, right? So nobody wants to leave because people are terrified that if they leave their apartment, they'll be homeless. They won't be able to get anything because no one's offering anything, right? It's just like waiting lists out 9 months. That's what data does, right? You follow it and it allows you to cheat along the risk-adjusted scale.